When the US Federal Open Market Committee announced the end of its bond buying program, many feared it would have negative implications for emerging markets. This is Tonight I'm Bruce Whitfield. Tonight I find out from Chris Becker, who's the lead economist and strategist at African Alliance, and Russell Lamberti, who's the head strategist at ETM Analytics, whether we should be worried. I think we probably should be worried, Chris Becker.
I don't think so. I think QE as a policy was a disastrous policy for the rest of the world. Essentially, the Americans took on the attitude of the Treasury Secretary of America about 3 decades ago, John Connolly, who said, the dollar's our currency, but it's your problem. They printed a lot of it. It flew out into the emerging market economies and inflated big unsustainable asset bubbles and business cycle booms in these economies. And that's what's currently unwinding. So I think
it's not a problem as long as it unwinds in a nice, comfortable and sedate way.
No, look, even if it unwinds aggressively and it causes big business cycle crashes in the emerging market world, but the Fed then decides not to relaunch quantitative easing and starts to gradually lift interest rates into positive real territory, for long-term growth prospects for America and also the rest of the emerging world is going to improve significantly. So, you know, to me, the end of QE is a good thing, and I hope they can sustain it, and we don't have, another round of like we had in QE1 and QE2, where they promised that was the end of it, but then they just moved into more rounds of QE. So let's see what comes of it. I think over the long term, if they do end QE, it will be a great thing for the emerging market world. It would stop the boom-bust cycles there if they don't embark on similar policies by themselves as well, though. So
okay, let's pause at that point. Russell, your view on it?
Look, I think Chris is a very optimistic chap, and I think that whilst I fully endorse his view that we absolutely need to normalize monetary conditions in the world everywhere. I mean, we've got synthetic interest rates across the globe. My big concern is just the difficulty with which that's with which that's going to play out, and I think that the Federal Reserve at some point is going to reignite the printing presses. It won't play well from a PR perspective. QE4 is not gonna play well, so they're going to try and forestall that inevitability. I just don't think that they can even raise rates without causing tremendous fallout in markets. So you've got companies across the world, in the United States, but also operating in Africa, who are addicted to extremely cheap dollar funding. And when you talk to some of these guys and say, what are your thoughts on a Fed funds rate at 2%? I mean, they have a hernia because they're just so addicted to these cheap funding channels. So I think that the going out of this liquidity tide, if you like, is going to create some tremendous fallout in markets.
Chris says the fallout's okay, though, because that will lead to some return to normality, except as long as you're not caught in the fallout.
We need the fallout. We need considerable correction in the global economy. We've had cheap money flooding out. It's created a lot of, as Chris says, unstable boom-bust cycles, a lot of malinvestment in various pockets of the economy. It's juiced up equity markets and asset markets while real economies have not really responded, so you've got these strange dislocations going on. So yes, I mean, if there is the political wherewithal and kind of fortitude to really normalize monetary conditions, I'm all for it.
But that's the point, isn't it? It's about the politics, because the politics can't possibly allow that normalization, because you have fallout, you have social instability, and people find themselves shot in their palaces. Nobody wants that if they're in power.
Yeah, sure. No, they don't. I also just want to add, where the Fed, the American central bank, has now ended money printing for a while, probably at least. The Bank of Japan has announced quite an aggressive monetary stimulus program. So
the Europeans
and
are
Mario
tinkering as
Draghi
well,
and the Europeans are looking at ways to also print a lot of money. So, to me, it actually doesn't matter who's doing the lifting, as long as somebody's doing the lifting. So, I think ultimately in the bigger scheme, the currency wars are continuing to play out. That's what's happening now with the Bank of Japan pushing back and the ECB trying to push back. I mean, essentially America's been quite lucky in a sense that they've been able to print a lot of money, but there's been a lot of weakness in the rest of the world. That prevented the dollar from weakening, because you've seen money rotate out of these weak economies in the rest of the world into America. And so the US Treasury Secretary was in town, and I went to a talk that he presented at Gibbs, and basically he was sort of very proud and broad-chestedly said, QE's worked, deficit spending's worked, and everybody just needs to copy us. And I think everybody's going to do that. Also, what you were saying was, whereas 2-3 years ago, nobody was looking to them for guidance, today, because of what's happened in the US, where the economy is essentially firing on all cylinders at the moment, we don't know if it's going to be able to sustain itself, but everybody's now looking to them for guidance and trying to implement the same policy. So,
what's the consequence of that?
Well, I mean, I think that Chris is right. We're on a currency war path, and if you like, in that great big war, America's kind of taking a breather and reloading some of its armaments. While
a report from HSBC says we're on the brink of the biggest dollar bull market in recent history.
Look, I mean, the dollar is certainly strengthening, and there's a lot of favourable sentiments around the dollar. I think that's going to extend into next year, but you know, and Chris and I were chatting off air. You know, I think that what we're really seeing is a rally in a very long-term dollar bear market, because at the end of the day, they are increasingly being forced to print money, to export those dollars to the rest of the world. But at the same time, every year, every month, the demand for US dollars globally is just diminishing slightly at the margin. You've got China and Russia who are antagonistic towards the dollar reserve system. You've got the BRICS who are trying to counter that. Now, those economies right now are quite weak, and so their credibility in countering the dollar right now is not so high. But I think that we are going to see a dollar rally. I think that when we see dollar rallies, it's typically associated with tightening liquidity in the rest of the world, and you're going to see the fallout start to happen. We've seen
what is that fallout? What does that fallout look like?
I think we've seen, so the canary in the coal mine is we've started to see wobbles on equity markets and some major asset markets. That's not going to just crash tomorrow, but we're in the process, I think, of a topping out of what's been a very long and overextended bull market.
I mean, the market's been running since 2009 with very few blips along the way.
So it's very overdue. I think that Africa, which is heavily reliant on dollar funding, is already seeing the fallout in terms of strain on fiscal budgets, in terms of growth and some of their own business cycles. And another good example would be the periphery in Europe. They are reliant on a loose dollar world, and when that dollar liquidity just tightens up, you start seeing some of the fallout. So of course this is why you've got Europe coming into the fray, and really I think what you're seeing is this inexorable path to continued printing. So the Fed's on pause for now, but QE4 I think is a word we're going to be using a lot in the future.
So how does this play out then for South Africa, Chris? Because here we sit with our own problems. We've got social issues, we've got political issues, we've got poverty issues, we've got enrichment issues, we've got tender issues, we've got electricity issues, and I'm reading a World Bank report at the moment which is telling us that no economy in history has grown with intermittent power supply. And it all sort of links to a very gloomy scenario for 2015, 2016 for South Africa.
Yeah, look, I think South Africa would be, as an economy, would be lucky to get 1% GDP growth this year. There are massive structural issues in this economy that needs to be resolved. There's inefficiencies within government, who is also a big manager of utilities and other segments, and obviously regulatory policies in this economy. And structurally, the policies that are being implemented and the areas that are being managed by government is essentially failing. We're seeing it in rolling blackouts, we're seeing it in water crises, and we're seeing it in the rand. You know, so there's big problems, and ultimately, what's going on globally doesn't have to affect us if our policymakers can do the right thing and deregulate the economy and move us up the doing business indices and rankings.
So we try to deal with facts.
It's obviously not what
we try to deal with fact here, not science fiction.
I'm just trying to say it doesn't necessarily have to be a bad story.
It's possible to do something about it, but we're not. We're sitting on our hands.
We just need to get the point across that there's something that can be done. It's not being done. It can be done.
Yeah.
Some issues can be resolved. In terms of going into next year, I think we're going to have a very weak growth environment. I think stock markets remain dislocated from the real economy. You see the speculative classes basically doing extremely well. Your wealthy classes who can profit off of this very easy money policies in the rest of the world. But that's very negative for your low-income earners who are in the townships, and trying to get a job, trying to get
ultimately it just leads to greater social dislocation.
Exactly. So that's where we're in right now, and I don't see any signs that that's going to reverse. This is a long-term trend, and it's very negative for a place like South Africa. And even in Africa, we're seeing that at the moment. I question whether the African boom has been so good for consumers. I don't think it has been. In fact, in our company coverage of consumer companies across Africa, we're actually seeing consumers buying down. They're buying cheaper blue line goods and services and products. In Nigeria, we're seeing revenues contracting year on year. So,
okay, I mean, in 30 seconds, because we're running short of time, how does that play out then? Because so much investment has been taken from a global picture. The old mutuals of the world have contracted, the standard banks of the world have contracted, and their new strategies are pan-African strategies, just in time for what? A slowdown on the African continent?
I think that we're in the dollar liquidity winter now, and that means that Africa slows down. It's not the end of the African story. Africa's got a great long-term trajectory, but this is what we call its test. This is now the big bump in the road. Some African countries are and will fail that test, and some will pass. As far as South Africa is concerned, we're going to see, I think, a lot of centralization towards the big urban areas. The outlying areas are under tremendous pressure. I think probably in a big depression already. So look to Joburg, look to Cape Town, look to Durban as your sort of centers of activity. Look to large
that puts those areas under pressure.
Does put them under pressure.
People then flood
and then I would say look to large listed corporates and your small mom and pop, small and medium South Africa is under tremendous pressure right now.
Okay, so that's the pressure. When does it get better? Is there a light? Assuming that Chris's ideal, you say he's an idealistic kind of guy, his ideal doesn't come to fruition. Government continues to sit in its hands and continues
Bruce,
to.
we're in a structural decline as far as we're concerned, and there's a couple major elements of that. We've got an overbearing state that consumes huge amounts of resources in the economy, and not only that, they produce laws and regulations. They just emit out of Parliament, daily. So these are stifling growth. And until there's a few other things I could mention. For example, we're in debt saturation in the sort of middle and lower income groups. So their contribution in the economy is going to be extremely weak. But until you see that considerable force for change at the top, very sort of almost ideological, philosophical change that says, we actually need to rein in this government. We need to deregulate. We need to free things up. My hope, and I think this is the most optimistic I can get, is that things get so bad, and I think that this is going to happen, that we're going to be forced to change. So we're already being forced to privatize certain state assets. We're in the process of talking about non-strategic assets. Well, guess what? That's going to start moving into talking about strategic assets as well, and that's a positive.
I was once shouted at by a dean of a business school when I said to him, things got to break before they get fixed, and I think it was right, Professor. That was Chris Becker, lead economist and strategist at African Alliance, and Russell Lamberti, Papa Bear and Papa Optimistic this evening. Russell Lamberti, the head strategist at ETM Analytics. Thank you for watching. There'll be more tonight, tomorrow, if the world's still turning. Good night and goodbye.